The White House is pushing the Court of Appeals to fast-track a ruling on firing Fed Governor Lisa Cook just days before the crucial FOMC meeting, as markets now reel from surging inflation, weak jobless data and shifting global currency pressures. For more, we'll head to Sydney now. We're joined by Steve Gopalam from Skander FX. Steve, why is the White House moving so quickly, trying to remove Lisa Cook ahead of this meeting?
Good morning, Aaron. Thanks for having me. Yeah, quite interesting developments happening in, obviously, President Trump wants to see that interest rates come down as quickly as possible, and looks like he's trying to win as much as votes he can. I think the thing that's stopping President Trump from removing Fed Governor Cook is because there's the Supreme Court's come out saying, she can still do her job, and she's acted in good faith while she still continues with her duties. But overall, arcing theme in the markets right now is Fed's independence is being questioned here, and it seems like any move the Fed does which doesn't support Trump's view is not going to be seen as a positive move. So looks like all pressure is on Fed President Jerome Powell.
Yes, but the problem here is that whenever Trump tries to make incursions to the independence of the Fed, the markets and the broader community just simply does not like it.
There's a lot of conflicting themes happening here in the markets at the moment. Obviously, the Fed's independence is at question. At the same token, also the data that's been coming out from the US has not been really that great. So, even though Fed Powell clearly said Fed's mandate is purely jobs, looking after jobs, and that's the number one priority. The last few batches of data that's been coming out has been very poor. So markets of the belief that, hey, even though Trump is not 100% correct in trying to force the Fed to act, and saying that the data supports a rate cut from the Fed and feels like they're behind the curve over here. So a bit of conflicting views happening in the markets from the internal dynamics. But overall, we've seen that the Fed is under pressure to act.
Very much so. But I guess, how does this fight between Trump and the Fed Reserve and different governors, including the Fed Reserve Chair himself, how does it impact perceptions of Fed independence?
Very, very crucial, right? So, I mean, if imagine that the world's largest and strongest central bank with the biggest balance sheet, if it starts acting on the terms of a president who wants their central bank to run like the way his economy does, it's going to be very much not going to sit well with market participants. Markets have always been booming on the fact that it's an independent place where buyers and sellers can trade, and no third party would come and intervene. So this pretty much, if by moving the interest rates or by asking the Fed to deliver those rate cuts or pressurizing them, it feels like it's a one-way agenda, which I don't think will sit well with any of the
markets. Obviously, and that's what we've seen. Why do the jobless claims, what do they reveal about the US labour market?
Yesterday's data that came in from the unemployment claims was quite interesting. We saw the markets have, we know that the U.S. economy is slowing down, and we heard from the Bureau of Labor Statistics, they had revised all their previous unemployment claims and everything. And look, the markets, unfortunately, are unable to catch on to a theme at this stage. They're seeing that there's the weekly unemployment claims rising up. It could be partly due to the tariff-induced pressures as well. We had the inflation data that came out yesterday from the US as well, and pretty much the unemployment data eclipsed the inflation data. So it kind of sits well where the markets can see that the US economy is slowing down. Not 100% to do with tariffs as such, but the economy slowing down, and looks like the pace of jobs creation is also coming slowly. The only anomaly was Texas had reported a positive sign where less unemployment claims were added. So you can make what out of that, but in saying that, I think the markets are 100% convinced that we have a rate cut coming in from the Fed this next week. So for 25 basis points, looks like it's a 100% deal.
Talk to us about the rise in the August CPI. How significant is that for Fed policy?
Very important. inflation is one of the crucial drivers for monetary policy setting. What we saw in yesterday's data for August showed that, look, the inflation data was pretty much in line with expectations. However, the only anomaly was there, if you were to look for the last 12 months, August to August, it slowly, if you strip out the components that the Fed looks at, which goes into their PCE deflator, it came in at 3.1%. So just slightly above their preferred level. So that usually should be stopped from if there was nothing else happening, right? So that would be considered as a sign that the Fed is probably not in a hurry to cut rates. But uh, as I said earlier, the unemployment data or the jobless claims eclipsed the inflation data for the first time, and the markets are convinced that, look, the U.S. economy is slowing down, so the Fed's probably going to act. Just on looking at the inflation as well, even though the tariff-induced pressures are, it's seen into the, it's you can see it, move into the inflation data, and that was quite evident in the key components as well. So. I don't know if tariffs is good for or bad for economy, but I can tell you one thing: Trump, if President Trump is watching the inflation data, he's probably going to be blaming someone and
Yes.
not himself for causing these rise in inflation.
Yes, very much so. My last guest was telling me how better the economy was looking at the very start of the year. Now, talk to us about the fact we know that there is a rate cut very much priced in for September, but could a second cut in October destabilise confidence in the Fed? Could it look like they're giving in to President Trump?
Good question. And look, we looked at the Fed dot plot, and it looks like close to 73 basis points worth of cut is almost priced in, right? That's between now and end of this year. So we are at September, and pretty much really got 3 more months to go. And so looks like the Fed's going to be in a hurry to cut heaps of rates. What is concerning is that they also have an additional 73 basis points worth of cuts priced in for next year as well. So I think, as President Trump said, that he would like to see the Fed funds rate to sit at number two, or at 2% or below. I think at some point in time, we're going to see a massive shift in the market. So, look, if the data supports it, and if inflation is heading down and unemployment levels, the claims or the unemployment jobs creation numbers keeps increasing, I guess the Fed has no other choice but to cut rates. Whether it gets more pressure from president that's wanting the Fed to cut rates, or it's as you can next year we've got Jerome Powell leaving as well. So depends on who replaces him. And right now we're seeing that the number of Fed meeting, the Fed voting governors, the doves are like, it's almost the camp is leaning towards the dovish camp. So what that tells me is that once Jerome Powell's out of the way, I think cuts are coming.
All right, how does a dovish Fed set the stage and the tone for the Australian dollar to break out of its current range and potentially push above 70 US cents next year?
Australian dollar is a risk currency, and people, the animal spirits return when risk is on. From what I can tell you is that, look, an ultra dovish Fed, or a Fed that's very much cutting on rates, it's just going to keep pushing our interest rate differentials, right? So we'll see more investors parking money back into Australia, and as such, we will see demand for Aussie pretty much heading up. We've seen the cross close to 67 handle, and it's been a level that's been held on for a while. That's going to change. We're going to see importers finally having a bit of breathing space. We're going to see the dollar close to 70 cents towards the mid of next year, and that's just purely because the Fed's cutting. Hedge fund investors or sophisticated investors are going to park money where they can still get premium yields. And I guess if they were to look at choice for destination, will probably be on Australian shores. And just also to that point, we've heard from ECB last night. So President Lagarde has come out and said that, look, the ECB has done a good job. They reckon that they're done with the rate cuts too. So I guess that's probably going to be another reason why the US dollar is taking a bit of hit as well.
All right, we'll leave it there for now. Stephen Goplam from Scanner FX. Appreciate your time. Thank you.
Thank you, Aaron.